The S&P 500 consumer discretionary sector rebounded strongly since April, amid anticipation of interest rate cuts and de-escalation of trade tensions, while recession fears dissipated. U.S. GDP expanded at a 3.3% annualized pace in Q2 2025, topping the initial 3.1% estimate driven by stronger consumer spending and business investment. Americans are continuing to spend despite tariffs and economic uncertainty, largely due to a steady job market. Heather Long, chief economist at Navy Federal Credit Union, said, "Economic expansion is positive for the consumer discretionary sector." The Atlanta Fed expects the economy to continue expanding in Q3 25, albeit at a lower rate. The IMF in July raised its 2025 world output target by 0.2% to 3.0%, lifting projections across most advanced and emerging markets. The IMF said the upward revision was based on assumptions of lower tariff impacts and improvements in global financial conditions. However, the IMF warned risks to the outlook remain, given a rebound in effective tariff rates could lead to a slowdown. Economic growth and lower interest rates typically boost cyclical stocks. As history has shown, consumer discretionary stocks have outperformed in expansions and recoveries but lag during downturns and recessions. Cyclicals benefit from lower interest rates because lower borrowing costs stimulate consumer spending, while investor funds flow away from defensive stocks into sectors like tech, communication, and consumer discretionary. Consumer discretionary stocks surged after Fed Chair Jerome Powell's dovish comments at Jackson Hole on August 22nd, which raised traders' odds of a September interest rate cut. After bottoming in April, cyclical stocks have come roaring back as trade tensions eased and consumer spending rose. The S&P 500 consumer discretionary sector is up in the past 12 months, handily outperforming the broader market. Consumer discretionary is the second highest performing sector in the past 30 days, up more than 3%. The sector performance has impacted stocks across a wide range of industries and countries. Let's dig into 5 surging cyclical stocks poised to benefit from a potential increase in consumer spending and sector rotation. We'll have a look at 5 stocks that have helped lead the surging consumer discretionary sector. Up by 95% on average in the past year, all 5 stocks have A's in momentum and strong growth and ESP revision grades. Headquartered in the US, China, or Hong Kong, these stocks include travel, gaming, education, coffee retail, and optical care businesses. Carnival Corporation, the among top-rated stocks in the hotels, resorts, and cruise lines industry, is up 90% in the past 12 months, crushing the market and sector. The stock surged in the past 3 months and 30 days, underpinning an A momentum grade. CCL operates a portfolio of cruise lines spanning North America, Europe, and Asia, including well-known brands like Carnival and Princess Cruises. Carnival has been boosted by robust cruise industry growth, which is expected to see total passengers rise by 3.1 million to 37.7 million. The cruise liner's strong growth and profitability have also been driven by consumer willingness to pay higher ticket prices, expanding cruise demographics, and increased capacity from new builds, according to the analysts. Strong demand and cost discipline helped Carnival operating margins hit 20-year highs in the second quarter. Q2 marked the 8th quarter in a row Carnival achieved record revenue on record yields. Carnival also achieved record-high quarterly EBITDA and all-time high customer deposits. CCL increased its full-year net income guidance by $200 million to approximately $2.7 billion, citing higher yield expectations. EPS grew by 160% in the past year, driving an A growth grade. ROE of 30% and EBITDA margin of 26% drive CCL's top-notch profitability grade. CCL beat earnings for 8 straight quarters, has 24 upward earnings revisions to 0 down revisions in the last 3 months, while EPS is projected to grow by 40% in FY25, according to consensus estimates. CCL has an average valuation grade, trading at 16x earnings, a slight discount to the sector, but showcases an attractive forward price earnings to growth ratio that's almost 60% below the sector median, driven by strong long-term earnings growth estimates. A leading position in the growing cruise market, high earnings growth potential, and scorching momentum make CCL a strong buy stock. Hong Kong-based Melco Resorts and Entertainment develops, owns, and operates gaming and integrated resort facilities in Asia and Europe, with flagship operations in Macau, the world's largest gaming market. Among top-rated casinos and gaming stocks, Melco is up more than 90% in the past year and more than 50% in the past 3 months, soaring above 5-year averages for an A-plus momentum grade. Macau is expected to benefit from lower U.S. interest rates because Hong Kong follows Fed policy, with its currency tightly pegged to the U.S. dollar. Melco had 4,588 hotel rooms in Q25 in Macau and 2,239 spread across the Philippines, Cyprus, and Sri Lanka. Macau revenue hitting post-pandemic highs helped push Melco occupancy rates up across the board. Melco Q2 revenue grew nearly 15% YOY and EBIT plus 35%. EPS long-term forward growth rate is a mind-boggling 84%, earning an A-plus growth grade. City of Dreams Macau and Studio City set records in mass-market table games revenue, while margins were boosted by efficiencies and cost reductions from comps and marketing spend rationalization. Melco showcases 20% plus EBITDA margins versus 11% for the sector. MLCO is trading at a solid valuation relative to the sector, with forward price earnings to growth at 0.19 and 6x price cash flow. Melco earnings are projected to grow by 350% in FY25 and plus 65% in FY26. The diversified footprint and strong growth make Melco a solid stock for exploiting the section rotation into cyclical stocks. Laureate Education is a Miami-based company that provides education services with a focus on Mexico and Peru, up 80% in the past year, far outperforming the sector and near peers. The stock is showcasing strong momentum and profitability factor grades and improving growth. Laureate projects student enrollments to grow to 491,000 to 495,000 or 4 to 5% this year, and raised Q3 revenue and EBITDA guidance with 2 new campuses expected to open in September. Eilif Sirk-Hansen, president and CEO, said the company remains confident in the growing demand for quality, affordable higher education across both markets and its ability to capitalize on those growth opportunities with leading brands and strong digital capabilities. Laureate has delivered strong profitable growth and cash flow with a levered FCF margin at an astounding 18%. Driving an A profitability grade. LAUR earnings are expected to drop by 19% in fiscal year 2025 before bouncing back in fiscal year 2026 by 26%. The stock is trading at a solid valuation with PE at about 16x and price earnings to growth on a trailing 12-month of 0.52. Luckin Coffee is a retailer of freshly brewed coffee, primarily based in China, although the company is expanding its footprint into Singapore, Malaysia, and the United States. Luckin opened 4 U.S. locations in New York City this summer. The locations feature a cashierless format that requires customers to pay via mobile or QR codes. The stock is up about 86% in the past year. Luckin's U.S. entry is part of a broader international expansion strategy, CEO Jinyi Guo explained on the company's Q2 earnings call. The U.S. is a highly developed coffee market, and we remain in the early stages of exploration. Our approach will be disciplined and deliberate, with a focus on validating consumer response to our brand positioning, digital ordering experience, product portfolio, and pricing strategy. Through this early phase, we aim to establish Luckin's unique value proposition and the customer experience in the U.S. market while building localized operational capabilities to support future scaled expansion. Luckin revenue grew 40% in the trailing 12 months and EBITDA by more than 100%. EPS forward long-term growth rate is at 23%, driving an A growth grade. EPS is projected to grow 35% in FY25 and revenue by more than 40% to $6.71 billion. Luckin's PE is in line with the sector, but forward price earnings to growth ratio of 0.84 represents a significant discount. Luckin is a fast-growing Chinese coffee retailer penetrating international markets in a high-performing sector. National Vision soared more than 100% in the past year and is a specialty retail stock. The Georgia-based optical retailer offers eyeglasses, contacts, and eye exams through 1,240 stores, led by top brand America's Best, which accounted for 85.7% of National Vision's Q2 revenue. National Vision beat earnings estimates for the 10th straight quarter, with Q2 EPS of 18 cents topping consensus expectations by 31%. Refinements to pricing and assortment supported solid sales growth across Eye's brands. National Vision recorded its 10th consecutive quarter of positive same-store sales growth, up 6.5% year over year. National Vision raised its FY25 outlook for revenue, earnings, and operating income. Eye's EBITDA is up more than 20% in the past 12 months, and levered free cash flow more than 130%, with EPS long-term forward growth rate at 22%, driving a B-plus growth grade. Eye has strong earnings growth prospects, as evidenced by the consensus EPS forecast to rise more than 32% in FY25. Eye has surprised to the upside in 10 straight quarters and has 9 upward earnings revisions to 1 down revision in the last 90 days. National Vision has a C valuation grade, driven by a high PE multiple, but forward price earnings to growth of 1.46 is a 20% discount to the sector. Despite shares getting battered in the last few trading sessions, Eye is still a strong buy, with excellent overall momentum and solid earnings growth potential. These top consumer discretionary stocks have strong overall investment fundamentals and could benefit if the Fed cuts interest rates and the economy continues to grow. They are well positioned to capitalize on cyclical trends and may receive an additional boost as expectations rise for a potential Fed rate cut on September 17th. I don't currently own any of these stocks. I just wanted to share my views on other industries that I'm generally less enthusiastic about. I usually avoid investing in cyclical stocks. That's all for now. See you in the next one.